the real wealth that is made is your freedom, because wealth is measured in time, richness is measured in money. So when we talk about can real estate make you wealthy, well, you got to understand what is that wealth, because people's definition of wealth is confused. Real estate buys you freedom, because now if you can buy these rental properties, which are paying you every single month, and if the income from your rental properties can cover your expenses, now you are wealthy.
I saw on Bigger Pockets this article that was talking about investing in real estate rentals and how it won't bring you massive wealth. I want to hear your thoughts on this because I know you are a massive real estate investor.
So investing in real estate, when I invest in real estate, I look for cash flow. And the way that I measure my real estate deals is I look for a 7 cap. A 7 cap means a 7% cash on cash return on my money. I invest $1, I want to make 7 cents in profit for that $1 investment. If I invest $1,000, I want $70. If I invest $100,000, I want to be making $7,000 a year in positive cash flow. Now, it's very easy to see that, okay, based off of that analysis alone, real estate is not going to make you wealthy, because if you want to make, I don't know, a decent income, you're going to have a lot of money invested. I mean, you'd have to invest based off of a 7% return, $300,000 to make $21,000 a year in positive cash flow. You'd have to invest $1 million of your own cash, your own capital. So you work to make $1 million, you take this $1 million and you invest it, and now you're making $70,000 a year. So based off of the rental income, you're not going to become wealthy. But what it does do is it provides you a new stream of cash flow. It provides you with consistency, because now, hey, if I go out and I do a bunch of dumb spending, like I did when I was 16 and 17 years old, if I go and blow all of my money, if I go to Vegas and I go blow all of my money, well, guess what? Next month, I get another check in the mail. I get my rental checks in the mail, which refuels me. So it's not going to make you massively wealthy by investing in real estate, by just investing in passive real estate alone. Because what you're trying to do is you're buying cash flow when you invest in real estate. I don't buy real estate to go and flip it tomorrow. When I buy a property for $1 million, I'm not thinking, okay, I'm going to flip this for $2 million next year. That's not my game. When I invest in real estate, my game is, how much is this going to cost me today? What do I got to do to renovate it, if so? So what's my total cash involved? Then how much is this going to pay me in profit every single year? And then my goal is to invest in an area where there's growing demand, growing business, more money flowing in. That way now, if the area, the city, this neighborhood, whatever it is, if more people want to live here and you see more people coming in, well, then the value of this real estate is going to go up, which in turn would also mean that the rental prices are going to go up, because now guess what? 10 people want to live in this apartment complex. So that's going to naturally drive up the rental prices, because it's in the area where people want to be. And because I want to invest in real estate that actually provides value, right? I don't like the idea of being a slumlord. I think that's a bunch of crap, of just renting out crap properties, not taking care of your tenants, not taking care of units. Every single one of the rental units that I have invested in, I make sure that, one, we keep it in good shape, we take good care of our tenants. We want to provide real value, right? That's the whole point. It's the more value you provide, the more money that you can make. And so if it's in an area, a highly desirable area, well, guess what? Rental prices are going to go up. Now, does this mean that there's no other ways to make more money in real estate? No. You can make money in real estate in a lot of different ways. You can be a real estate agent. You can be a real estate wholesaler. You can be a real estate developer. You can be a real estate flipper. But if we focus just on the real estate investing side, what is real estate investing? Well, real estate investing is when you buy an asset, in this case real estate, you're going to hold on to it for a long time. So you're not flipping it. When we talk about holding on to it for a long time, we're talking about at least a year. Well, how do you make money off of an asset just by holding it? If you're just holding on to a stock that doesn't pay dividends, how do you make money? Well, you only make money when you sell. I buy a stock for $10, it goes up to $20. Well, I don't actually make $10 unless I sell that stock. Now I sell the stock, and now I make $10. With real estate, I don't got to sell my properties to make money. I own it, and they continue to pay me with cash flow, even if the value goes up or down. I continue to get paid with cash flow. So that's my investment. So now how do you have the ability to get better returns in real estate? Because that's, a lot of people are going to hear that and say, man, 7% return really isn't much, because, I got to buy $1 million worth of real estate in order to get $70,000 a year. It's going to take me a long time to accumulate this $1 million. Well, the first thing that you can do is you can use leverage, debt. If you use debt to invest in real estate, you now have the ability to earn potentially a higher return just because now you have less capital of your own money invested. If I buy $1 million property and I use debt, I might only need $250,000, maybe 200, but let's just say $250,000 of my own cash to go out and buy it. So I'll put in $250,000. I borrow the money, the other $750,000, and now I buy $1 million property, which is going to pay me with rental income, and now I got to pay back that $750,000. If I can get cheap enough debt, well, now this is going to be beneficial for me, because if I can get a 7% return and borrow money at 4%, well, then I'm coming out a winner. So that's the first thing you can do. The second thing you can do is be more involved with the real estate. How do you get better returns? Well, this gets kind of on the mix of development / rehabilitation, rehabs. Now, I'm not talking about rehabbing for flipping. I'm talking about actually renovating a property. So I love the idea of buying real estate and revitalizing it. I love doing that because, one, you get to find a property is fun. You get to find a property that's beat up. You find a property that doesn't look like anything. You walk through it and people hold their nose because it smells like crap. You might see mice running around. You might see holes in the walls. You might see carpet with crap all over it. And most people come in and they say, this is disgusting. Nobody's going to want to live here. And what happens? Well, then nobody makes an offer because nobody wants to buy this piece of crap. Well, I come in and I say, okay, what work does this property really need? Okay, we need new carpets. We might need some new drywall. We might need to renovate the kitchen. We might need to update the lights. We might need to redo the landscaping. We might need to paint all the walls. What is this going to cost me? $25,000. Okay. I want to see, is there any major repairs that are needed? Major repairs meaning, do I need to lift the property higher because the property is crumbling? That's expensive. I don't like doing that. I had to do that before with my worst real estate deal ever because I didn't know what I was doing. So I don't want to do that anymore. Unless I can get a really, really good deal on a property. But in general, I don't like to get into that. Mm-hmm. What about the roof? Is the roof needing replacement? If so, how good of a deal can I get on the property? So I'm trying to see what type of repairs are needed. Now, if I see, okay, this property needs about $25,000 worth of repairs, I have a pretty decent eye now of how much these repairs are going to cost me because I've been in the game for a while and know a handful of very, very, very good contractors. And the way that I found these good contractors was by going through a whole bunch of bad contractors, some of them who screwed me over, some of them who stole money and ran, some of them who didn't do the work, some of them who did really bad work. So how do you find good contractors? Is by going through how do you find good contractors? By going through a bunch of bad contractors. So now that I found good contractors, I can kind of get a good estimate of what renovations are going to cost me. So if I can estimate that these repairs are going to cost me $25,000 and I can buy a property for $50,000 below market value because nobody wants to buy it, well, now I can come and buy a property for a discounted price, renovate it, and now I just bought a property with less cash where I can get the same return, same cash flow as a more expensive property, which just boosted my cash flow. So, when you talk about how do you increase your returns, it's how much more work are you willing to be involved in? Or you can get more involved on the development side. So, I don't agree with the idea that real estate won't make you wealthy, but the traditional idea of rental properties making you wealthy, yeah, it's much harder. Because when people rely, if they think that, okay, if I want to become wealthy, all I got to do is buy a few rental properties. Sure. But it just depends on what your definition of wealth is. If your definition of wealth is I'm going to be driving around in Ferraris and Rolls Royces and I'm going to have nice watches because I bought a few rental properties, it doesn't really work like that. Because what you're trying to buy is freedom. It takes a little bit more work. Now, real estate is one of the best investments that you can make. Many wealthy people have built their wealth through real estate. I 100% agree with that. I love real estate investing. I think you can make an immense amount of wealth in real estate, but I just want people to be realistic about what type of returns they can expect. If you go in thinking, I'm going to invest $100,000 and I'm going to make $100,000 a year in cash flow, that's not how it works. And I think that's what people get mistaken because they hear people, say, oh, I have these properties and I'm making all this money in real estate, but they don't understand what a real return in real estate is. People confuse the potential appreciation with the cash flow. I can buy a property for $100,000, put in a little bit of money, and then sell it for double. That is possible. And now I can make $100,000 worth of profit. And you can make a lot of money doing that. But that's not real estate investing. Real estate investing is me buying a property holding on to it for a long term and generating the cash flow. And the real wealth, because now we would talk about what is wealth, the real wealth that is made is your freedom. Because wealth is measured in time, richness is measured in money. So when we talk about can real estate make you wealthy, well, you got to understand what is that wealth, because people's definition of wealth is confused. Real estate buys you freedom, because now if you can buy these rental properties, which are paying you every single month, and if the income from your rental properties can cover your expenses, now you are wealthy because you did it right. You understood the definition of wealth, and now you bought that freedom. So you're taking your cash flow, you're taking your money that you're earning, whether it's from your job, your business, your active investments, whatever you're doing, you're taking this cash that you're accumulating, you're buying these properties which are not paying you with cash flow, and now you're building real wealth, time, through your real estate. But you have to understand what that means, and you have to understand how to calculate that.
How much has rental real estate really changed over the last year and a half? Because I know, a lot has gone on with people not being able to afford payments on mortgages and renting and things like that. So, how much has it changed? Is it more risky now? Is it less consistent?
So how much has rental real estate changed since the pandemic started? Well, I think the concern that people have is what we saw happen as soon as the pandemic hit. The government said you no longer have to pay a rent. Well, now, if you are a landlord, you're a real estate investor, and everyone assumes that real estate investors are all these rich people, but what they don't understand is that real estate investors are oftentimes using leverage, and they don't have millions and millions of dollars of cash piles just to sit and fall back on. Mm-hmm. So now you're a real estate investor, you have properties, you may or may not have leverage debt on them, but you have expenses you have to pay. You have to pay property taxes, you have to pay your property manager, you have to pay your maintenance fees, you have to pay your insurance, you have to pay your water bill. So you have a lot of bills you have to pay, and the income to pay these bills comes from your rent. And so now you own these properties, and the government says your tenants don't have to pay you, so your expenses don't magically go away, but your income goes away. Well, what does that mean? Well, you have no income coming in, but your expenses don't. So money flows out, but no money flows in. Well, you should always have some reserves. We always keep cash reserves. But if you don't have any cash reserves, what happens? Well, now either you dig into your own personal pockets, not your real estate pockets, but your personal pockets, and you start paying, or you lose the property. And that's what we saw happen during the pandemic. We saw some people who were not prepared. They didn't have cash, and now they really started to struggle. Some people were forced to sell. They were forced to give up the properties, or they went into default on the properties because they just didn't have the cash coming in. I was pretty fortunate. As soon as the pandemic hit, there was a lot of crazy stuff going on, and you kind of had this real dynamic and war going on between tenants and landlords, where landlords hated tenants and tenants hated landlords. So what I tried to do is, as soon as we saw this happen, I worked directly with the property management companies, and I said, okay, what can we do about this? Because this is a real issue. People are losing their jobs left and right. We don't know what's going on with the pandemic. People are getting sick. We don't know how bad this thing really is. It was a lot of uncertainty. So we sat down and we were like, okay, let's create a program for our tenants. That way they're transparent and open with us, and we'll be open and transparent with them. And we will work to give them breaks because, before the stimulus checks went out, a lot of people just had no money. So we created a program right away with our tenants where, hey, if you can't pay, we will work with you. We're not going to try to kick you out. We're not going to hold it against you. We will work with you. We'll create a program as long as you're open and transparent with us. And that worked out really well. And I mean, it was just it was weird because it really wasn't that big, mind-blowing program. It was really okay, let's communicate with the tenants, let them know that, hey, we're willing to work with you, just be willing to work with us. And the tenants loved it. They were like, wow, I really appreciate that, and so we really didn't have, personally, I really didn't have many issues at all with the pandemic, people not paying rent. I mean, anytime I talk about real estate investing, that's one of the biggest criticism. Well, what happens if people don't pay rents? Honestly, I didn't run into that issue. Maybe, I was just fortunate, but I think a big piece of that is just, we were willing to communicate with the tenants. The second thing is, okay, so how is that going to change going forward? Well, going forward, what does this mean? Can the government potentially tell people to not pay rents? Sure. I mean, they did it before. Maybe they can do it again, but they can't do that forever. I mean, or maybe they can, but you assume that they can't do it forever.
Right.
And I don't like to make decisions based off of, what the government will or will not do. I mean, you have to kind of be aware of it, but at the end of the day, I don't think that the government can tell a tenant to not pay rent forever. So when I make my investment decisions, I don't think that the pandemic has changed the attractiveness of real estate. To me, it's just as attractive as before. The difference now is property prices have gone up a lot. I think that's the biggest difference between prior to the pandemic and post-pandemic is you saw a huge surge in home ownership. You saw a huge demand in people wanting to buy a home, which ran up housing prices. And it wasn't just housing. Apartment prices skyrocketed. And I'm talking about not just the rental price, but the actual price to buy an apartment complex. There was a very low inventory of homes and apartment complexes for sale. And then you had a lot of people that were like, okay, I don't know what's going on with the pandemic. Inflation is a real thing. I'm going to move my money out of cash and move it into real estate. So people started buying up apartment complexes. So it's the same thing you saw in the housing market, in the real estate investment market, where people were now trying to buy real estate, rental properties, either single family homes or apartment complexes, because they want to get their money out of cash. So, but you see these cycles happen in every asset class: real estate, stocks, cryptocurrency. You see booms, you see busts. But I don't think it permanently changed it in any way. Sure, temporary, you're seeing very high prices. But again, when I look for real estate properties to buy today, I'm just trying to be smart. I'm being pickier with the deals, right? I mean, like compared to a decade ago, the deals now are still there. They're just not as many as there were a decade ago. So what does that mean? Well, I'm looking for deals. I just got to be pickier. So I got to spend more time now than 5 years ago, 7 years ago when I was looking for properties. I got to spend more time analyzing deals. I got to spend more time going through the deals. I got to spend more time crunching the numbers, because I'm always worried about the worst case scenario. I mean, just take a look. We got tulip mania, the first real estate bubble that happened there. We got previous crashes behind me. What does this mean? Like, I understand that, bad things can happen. You have to be aware of them and protect yourself from them. Now, I'm not scared of it, but I am worried about it. I'm always worried about that. And that's what you have to be aware of. I mean, we have a lot of issues in our economy with the dollar losing value, the government printing money with the Federal Reserve Bank. All these things have implications. And it's building up to something bigger. I mean, we keep doing more and more and more of the same thing, which creates more problems in the economy, creates more volatility in different asset classes. So, I'm worried about an economic slowdown, always. But am I fearful of it? Am I scared of it happening? No, I just protect myself and I prepare for it. So what does that mean? When I go look for properties, people marketing properties based off of what their future profits and rental prices will be. So they say, okay, I have a property today. I'm not going to sell it to you based off of what today's prices are, because if I sold it to you based off of today's profits and I sold it to you on a multiple of, let's just say 10, so this property generates, assuming $10,000 worth of profit, then if I sold it based off a multiple of 10, that means this property is worth $100,000, 10 times earnings. What they're saying is, in a few years, this property is going to generate $20,000 worth of profit. So I'm going to sell it to you for $200,000, a multiple of 10, maybe even a multiple of 20 times the future earnings. Now, how did they get to that $20,000 of future profits? What they're saying is we're going to see these rental prices grow year over year over year. And because of this rental growth that we're going to see, this property is actually worth 2x or 4x what you think it's worth. Now, I don't like to do that type of speculation. It's risky. I don't know what's going to happen to rental prices next year. Maybe they'll go up, maybe they'll go down. If the economy slows down and nobody expects it, I don't want to be the person that's holding on to the bag. I don't want to be the person that's holding on to this property that I overpaid for. So that means, I'm being pickier. I'm turning down deals that I think are overvalued. Does that mean it's more work for me? Yeah. Does that mean I have to lose out on deals? Yeah, it sucks. But you have to take the emotion out of the equation if you want to be an investor. You have to look at the numbers and focus on the numbers and know what you want.
I think that's one of the biggest things that people are afraid of when it comes to real estate investing in general, is the amount of work that it takes, and even more about the prices of the investment to get into it. Houses, rental properties can be expensive. So what are some of the benefits of people investing in real estate, which, takes a lot of work, versus some other passive investments like the stock market or
So real estate costs more money. Absolutely. If you want to go out and buy a full property, you need more capital because you got to go out and buy the property. Now, there's a couple things that you can do. First is you can look in a different area. If you're in Manhattan or San Francisco, or you're in a big city, chances are property prices are going to be very expensive. If you're in San Francisco or downtown New York, $1 million is going to buy you a closet. But there are other places where you can buy a property for less, significantly less. There's many places with growing populations where you can buy a property below the cost to build it. So what does that mean? Well, there's opportunity if you're willing to put in that work. Yeah, it's work. There's definitely more work required to buy a piece of property than, say, a stock. If I want to go buy a stock, you go open up your phone, go to a stock brokerage account, find the stock you want, hit buy, and you're done. With real estate, you can't do that. Yes, you could use services, crowdfunding services like our sponsor Fundrise. I mean, those are great, but you don't own the actual physical property. So what does it mean now with physical property? Well, physical property now, I go out and I actually own the land. I actually own the building that's on top of it. So if you want to look for more affordable real estate, look somewhere else. Look in the Midwest. You can find homes for under $150,000 that are going to provide you with great, consistent cash flow. Now, what about the work required? If you're not willing to put in the work, don't do the investment. It's the same with stocks. If you're not willing to do the research and put in the work on the individual companies, if you're not willing to listen to the earning calls, if you're not willing to understand the cash flow statements, if you're not willing to read the P&L statements, profit and loss statements, if you're not willing to do that, don't invest in individual companies. You're gambling. Invest in ETFs and make it passive. You don't have to be actively involved in the stock market. That's up to you. If that's not for you, that's fine. It doesn't have to be for you. So you have to be willing to put in the work. And the work is hard in real estate because now you got to deal with people. You got to know the right real estate agent or agents. You need to have a real estate attorney. You got to have the accountants. You got to have the property manager. You got to have the contractors. You need to talk to the people in the city. So there's a lot of different moving parts. You got to know the right people. And, the thing with people is things can go wrong. People can lie to you. People can try to scam you. People can try to screw you over. People can do things wrong. And so that's another part of our real estate where, things can go wrong. And it's not like where, a lot of people try to look at real estate just like numbers. Okay, I have to put in $100,000, $10,000 worth of repairs. I'm going to rent it for $1,200 a month, blah, 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 blah. Well, things can go wrong. You can do the repairs and find out, oh my God, something's wrong with the roof. It's going to cost us 30% more. It's going to cost us an extra $3,000. And you say, okay, I'm going to rent it for $1,200 a month. Oh, we can't find a tenant. Now what? Well, you got to lower your rents or projections were wrong. Or your tenant comes in and the tenant says, something's wrong with the furnace. You need to put in a new furnace. Or your tenant doesn't pay you. Or your tenant damages the property. You can't always factor these things in. Now, what I like to do is when I do my projections for any rental property, I always like to overestimate the expenses. I always like to factor in a vacancy cost because I say, I know the property is not going to be occupied 12 months out of the year. So I add in a vacancy cost. Most performers are not going to do that. So you have to, be a little bit more, however you want to be. I like to be a little bit more liberal when it comes to my expenses. I like to assume higher expenses. Same with my maintenance costs. I project higher maintenance costs. I hope my maintenance costs are not as high as I project, but I'm giving myself a little bit of cushion. If I get a higher return than what I expect, I'm not going to be mad. I'm going to be happy. But if I get a lower return than what I expect, well, now I'm not so happy. So that's where you have to be willing to put in the work. You have to be willing to put in the time. Now, how do you find the capital? Well, that's where everything else you do. Your job. If your job doesn't pay enough, create a side hustle. You can work a sales jobs that way you can earn commission. You can try to flip things. You can create your own business. I mean, there's a lot of ways to earn that capital. But now as you're taking the capital and you're putting it into real estate, that way you can get those better returns. Now you compare it to the stock market. What's the benefit of real estate versus the stock market? Well, with real estate, you own something that you can see, feel, and touch. It's tangible. You get different tax breaks. You get different cash flow. You control the property. I own stocks, but when Amazon makes a decision, I don't get to tell them what to do. I'm not in the board table making decisions, voting on things with them. Sure, when I own shares of a company, I get voting rights, but I'm not a decision maker of the companies that I'm invested in on the stock market. But in the real estate world, when I own a property, I'm the decision maker. I'm the one in charge. So, if some things go wrong, I can blame myself. So for some people, that's a pro. Some people, that's a con. Just depends on you.
So if it's not rental income, then how is real estate building massive wealth?
Well, if it's not rental income, the way that real estate can build you wealth is you own a property that's appreciating. Again, I don't do that. I really don't care what real estate prices are. It does not matter to me. I am not buying properties with the purpose of selling them for a profit. Now, would I like property values to go up after I buy it? Sure. Who doesn't? If I buy a property for $100,000, I would love for it to go up to value to $1 million. But that's not my goal. I don't even look at that projection when I factor in. The only thing that I'm looking at is rental prices, because that's how I make money. I make money through the cash flow, not through the appreciation. And this is what hurts people, is because they do the opposite. They look at the appreciation, and then that's how they assume that they can make wealth. And sure, you can make a lot of money on the appreciation side, but you're also speculating. When you're speculating, you take on a whole lot more risk. Can you see more returns? Sure, but you take on so much more risk because you assume, okay, this property is not going to make me much cash flow. It might only make me 2% a year in cash flow, which happens. I mean, we've seen this type of stuff happen where people buy properties at negative returns. Not only am I not making money, I have to put in money out of my pocket every single month. Why? Because I assume that I bought this property for $1 million. I'll be able to sell it for $1.3 million in a few months or a year. So you buy this property for $1 million. You go into debt to buy this property. You're putting money out of your pocket every single month. So you're working a job, you have this business, you're taking money from this business, and now you're using it to fund your real estate loans. You're paying off your loans, hoping that this real estate property is going to be worth more. And then what happens? Well, either property values go up and you can sell it, you got to pay all the fees, and you walk away with a little bit of a profit, or real estate properties stay the same, and now every single month you're just paying money out of your pocket to maintain this property, and now you're just trying to build equity in the property, and you're hoping that one day you'll be able to pay off the property, and now you own this property. Or real estate prices go down, and now what? Well, you've been paying this property, and maybe you continue paying, or maybe something happens and you cannot continue paying, and now you're underwater on this property. You bought it for $1 million. It's worth $750,000. You have more debt than equity. You can't refinance. You can't sell. Because now if you try to sell it, you're going to have to bring $100,000 to the closing table. And if you don't have $100,000, well, now you're stuck. So now what? Well, now you get foreclosed on. Then somebody else comes along, like me, who's going to come and buy the property at a discounted price. So this is where, I don't like to buy based on appreciation. If appreciation happens, that's great. I mean, there's nothing wrong with that. I've sold properties for a lot more than what I bought them for. That's great, but that's not the reason why I buy them. I buy them for the cash flow. And if you want to build wealth through the cash flow, you can, but you have to understand what is the wealth, and you have to understand what type of returns you're going to get by doing that.
Now, to kind of play devil's advocate a little bit here, you said real estate investing, it's a kind of a slow way to kind of build that wealth over time with appreciation, right? So with that being said, if I buy a house and I plan to sell it in about 30 years, wouldn't that be an investment? Wouldn't me buying a house and living in it as my means of housing and then selling it, isn't that an investment?
Your home is not an investment. The home that you live in is a liability. It's a money pit until you sell it. Your home is not making you any money as you live there. You're paying money every single month on your mortgage. You're paying money every time you want to renovate the kitchen. You're paying money anytime you want to renovate the bathroom. Now, what you're going to tell me is, but Jaspreet, I'm increasing the value of my home. Well, you're creating this increase in imaginary money. What is the value of your home? The value of your home is what somebody else is willing to pay. The only time you're going to see what somebody else is willing to pay is when it comes time for you to actually sell your home. So until then, your home is just a money pit. It's a black hole. You just keep funding your home with more money, more money, more money. Now, there's nothing wrong with owning a home, but you have to understand what it really is. My shirt is a liability, but I didn't buy my shirt for the purpose of making money off it. I bought my shirt because I wanted to wear it. You bought your home because you want to live in it, but it's a liability. Now, can you make money off your home? Sure. You can sell your home for more than what you bought it for, but that doesn't mean that it's guaranteed. So many people will buy their home and they'll put money in it, and then they'll find out when it comes time for them to sell, maybe they won't be able to get what they paid for it. And what you have to understand is it's not generating you any money. It's not generating you money like a rental property. When I buy a rental property, why am I buying it? I'm buying it with the sole purpose of making money. I'm not buying it for the purposes of creating memories. When I buy a home, I'm buying it for the purpose of creating memories, having a home for my family, having a nice home to stay in, having something where I can call home. So it's a different purpose. And then when you go to renovate your kitchen, guess what? You earn money, pay taxes, and then you're renovating your kitchen with post-tax dollars. When I have a rental property and I renovate the kitchen, I earn money, I pay for my kitchen renovation, and then I pay taxes on whatever's left. So I'm taxed differently, right? I'm making my renovations on my rental properties with pre-tax dollars, but you're making renovations with post-tax dollars. So it's costing you a lot more to do those renovations. And now you're speculating that, hey, once it comes time for you to sell, you're going to be able to sell it for a profit, which is not guaranteed. Home prices do not always go straight up. We answered a question from a caller not too long ago where the lady called in and she bought a home and they're underwater and they thought that there was an investment when they bought the home. And now I think they owed $100,000 or so on the home, or they were underwater by $100,000 and they wanted to rent it out. But the problem with renting it out was the rental payments weren't enough to cover all the expenses and the debt payment. So either they would have to pay $100 a month out of their pocket if they rented it out. And then if they sold it, they would have to pay $100,000 at closing. So it's a lose-lose. Home prices do not always go up. And then what the whole idea of your home being an investment, what does that do? It benefits the banker, and it benefits your real estate agent, and it benefits the government. The government wants to promote this whole idea of home ownership because then they can charge you higher property taxes. Well, if I tell you, if I'm a real estate agent, I used to be a real estate agent, I used to work as an agent. I still have my license, I don't work as an agent. But if I'm your agent and I say, so you got pre-approved for a $500,000 home, and you say, yeah, we want to buy a $400,000 home. What am I going to say? Well, your home's an investment. You want to invest something where you feel comfortable, but you have to understand that this is actually a savings account for you. You're going to build generational wealth for your kids. You're going to build wealth for your grandchildren. So buy a little bit bigger. And what's the banker going to say? Buy a home that you love. Buy a home that makes you happy. Buy a bigger home. So what does that mean? Okay, yeah, you can afford a $400,000 home, but now you get nudged towards the $450,000 and $500,000 homes because they're a little bit bigger, they're a little bit nicer, they're a little bit more grand, and it's an investment. So what's the big deal? Well, now you own this property, then what? Every single month you have money going to pay for your mortgage, right? When that money could be going to buy you a rental property. It could be going to invest in the stock market. It could be going to buying cryptocurrency. It could be going to buying gold. It could be going to buy other investments. It could be going into other startup ideas. You can invest in startups. You can invest in your own business. So you have this money that no longer can be used for something else because you wanted to buy this home. So now people stretch themselves so thin to the point where they're living paycheck to paycheck. Why? Because they wanted to own a home. And so they assume that home ownership is the best way to build wealth. And this is one of the biggest lies sold to the American people, that the way to build wealth is through home ownership. It's a big lie. It's a massive lie that they're using to get people to buy homes that cannot afford them. And now you're broke. Why? Because you own a home. Hey, but I own a home. Yeah, but you're broke. It's the reality. Renting is not always a bad thing. You can rent a home and build wealth. Why? Because now you didn't have to spend $40,000 as a down payment on your property and use that $40,000 to be a down payment for a rental property. Or use this $40,000 to invest in your business idea. Or use this $40,000 to invest in something that can make you more money.
But when you rent, you're spending money every single month and it's not going towards anything. When you actually own a home, at least you're building some equity in that home to eventually own it. And you say, well, it's speculative, but eventually you'll be able to sell that and at least make something. When you rent, you can't make anything.
When you rent, you are getting something. You're getting a roof over your head. Just like when you go to a restaurant and you buy a $100 meal, you're getting something. You're getting food, right? You're getting some sort of value, and you're buying that value. When you rent, you're getting a roof over your head. When you own, you're also getting a value. You're getting the home that you own. But guess what? When you own a home, you also bear the burden of home ownership, because now if something goes wrong with your home and you live in the home, who's going to pay the price? You. Window breaks, furnace breaks, roof breaks, you're going to pay for it. If you are the tenant, something goes wrong with the home, who pays for it? The landlord. It's the landlord's burden, not yours. Now, what if your job calls you and says, hey, we have to relocate you to the other end of the world? Well, if you're a tenant, you pick up and leave. You might lose a security deposit, but you can pick up and leave. You don't got that burden. If you're the homeowner, you have a mortgage attached to you. Now you're forced to sell or forced to do something else with the property. And now if property values at that time when you have to sell it are higher, great, you're okay. You're able to sell it for a profit. But if they're not, which has happened many times, real estate prices are cyclical. They go up and down. And so now if you're on the other end of the cycle, well, then what? Well, now either you sell it for a loss or you have to rent and hope that your rental payments are going to cover whatever debt you bought because now you bought the property at a higher price. So you bear different burdens as a homeowner. Now, being a homeowner is great. You own the home that you live in. And if you can own your home free and clear, now you have one of the biggest expenses of life covered. You don't got to pay for your home, which is great. But you do not want to stretch yourself too thin to go and be a homeowner. If you can't afford home ownership, be a renter, build wealth, then go and buy a home. But you have to understand the process. You have to know what it is. Do not stretch yourself too thin to go out and buy a home. Buy a home that you can afford and buy a home when you can afford it. Don't just buy a home because you think it's going to make you wealthy. If you want to become wealthy, buy a rental property. Don't buy a home to live in.
I think people are really scared of bad landlords, though. I know you kind of mentioned before about some things that you've done with your tenants, but there are a lot of bad landlords out there. I've heard a lot of horror stories. So you say when something breaks in a rental property, you know, it's on the landlord to fix it. But in a lot of cases, that doesn't get fixed for months. At least when you own your home, you make changes to it whenever you want to. But if you rent, you can't do that.
Well, if you have a bad landlord, that sucks and it's unfortunate. But you can always move. Mm-hmm. You can verify the landlord. I mean, there are ways to do that. If this landlord owns multiple properties and they have a property management company, read the reviews. You're going to see some property management companies suck. Some property management companies are going to be better. And you talk about you not being able to do anything. Well, you potentially could do things with a rental property if you're living there. Now, it defeats the purpose because now you're the one that has to pay out of your pocket to do that, but that ability is still there that you can do it. So, yeah, is that a risk? Sure. You have that risk with rental properties where you could have a bad landlord. But you have similar risks when you buy a home. You have risks that property values can go down. You have risks that things will go wrong. And if things go wrong, again, you have to bear the burden of it. You have to pay the cost. If you buy a home and you find out after you close that there is a leak under some of your drywall, which you didn't see, you didn't notice, you bought the property as is, and there's mold growing, then what? Well, now you have to take care of the mold because if you don't, your child could get sick. You could get sick. And replacing that can be very expensive. We're talking tens of thousands of dollars. If you have to repair the leak, well, now you got to repair the plumbing. And now these things add up. And now you have to be the one that pays the cost of that.
So when it comes to rental real estate, where do you kind of see the trends going in 2022? Do you see it getting a little bit harder to become a real estate investor, or is it actually getting easier to invest in real estate?
I mean, investing in real estate itself is becoming easier. Just like everything else. Investing has become easier because of technology. You can invest in real estate through different services. You can use crowdfunding services to invest in real estate. Buying physical real estate is easier because now signing paperwork is so much easier. Processes have become more streamlined. You need more capital than before because prices are more expensive in 2022 than they were in 2019, in 2015. But there are more resources and availabilities for you to do that. So, this goes more on the economic level than the actual real estate level. Buying and transacting real estate has become easier, but purchasing real estate has become harder. Why has purchasing real estate become harder? Well, you had the shift in supply and demand, but you also had the devaluation of your currency. The value of the dollar has gone down, and that's another reason why real estate prices have gone up. People are buying homes because they don't want to own cash, so they're converting their cash to real estate. They're converting their cash to properties, and this has made the price of these properties go up. So in that sense, it's harder. So how do you combat that? Well, that's more of how do I protect the value of my money? What do I do with my money? Do I own cryptocurrency? Do I own gold? What do I convert my money to? Now, the advantage with real estate is you can generate cash flow. You can get potential tax breaks. You own a physical piece of property. It has windows, doors, bricks, granite. It has real things that you can use. So has it become harder or easier? It just depends on who you're asking and what your definition of that is. Things are more expensive, but that doesn't mean it's impossible to find a deal.
So inflation is going up. In October of 2021, we saw inflation reach about, I believe it was 6.2% from the Consumer Price Index. How is that going to affect home prices in 2022?
Well, That's not a very
Is it at
easy
all?
question. That's not an easy question to answer. What's going to happen to home prices? Well, as long as you have more buyers and sellers, home prices are going to keep going up. Well, what determines if a buyer is going to be there? Well, the buyer has to be able to afford the home. Home affordability is going down by pretty much every metric that you look at, making it harder for people to buy homes. But people are able to subsidize these higher home prices through what? Low mortgage rates, cheap debt. And so what happens if mortgage rates go up? Well, the Federal Reserve Bank has come out and said that they want to increase interest rates. They say they want to do it in 2022. Sometimes they say 2023. But as of now, they're saying that they want to do it at some point in 2022. Will they? I don't know. We'll see what happens. But they keep saying that they want to raise interest rates. If they raise interest rates, what happens? Well, now these homes that are already not affordable are becoming even less affordable. The reason why people can't afford homes right now is because prices have gone up so much that even these low mortgage rates cannot subsidize the price of these higher homes. So now if mortgage rates go up even more, well, then it's going to become harder for people to afford homes. And if people cannot afford homes and wages don't keep up, well, then what? Now I list my home for sale thinking I'm going to be able to get $400,000 for my home, but I get no offers because this $400,000 home is now more expensive because mortgage rates are higher. So now maybe I have to cut the price of my home from $400,000 to $380,000 to get a buyer. Maybe I cut it to $360,000. And so that is possible if we see more sellers than buyers. If buyers start to walk away and we start to see more sellers, then we could see the price of things go down. What can cause less buyers and more sellers? Well, mortgage rates have a big part to do with that because mortgage rates are a huge piece of affordability. They make homes more or less affordable. So if mortgage rates go up, it's going to be more expensive to own a home. Now people are going to look at the home and they're going to say, yeah, this monthly payment is going to cost us 25% more than what we would have liked, so we can't buy it. Second thing is also going to be more an economic factor. Our economy is growing, but it's growing thanks to cheap debt. It's growing thanks to stimulus programs, and it's still not growing fast enough. We still have a whole bunch of economic issues. So now if the economy slows down, then what? Well, if the economy slows down, that means companies are making less money. If the companies are making less money, that means companies are probably going to have to lay people off. If companies lay people off, well, now you have more people without an income. If people don't have an income, they don't have a way to pay their mortgages. If people don't have a way to pay their mortgages, then that hurts the housing market because people cannot buy homes or they cannot continue making the payments on their homes. So in that sense, if we see an economic slowdown, that's going to also hurt the housing market. So are we going to see housing prices go down? Maybe. I think seeing a correction in home prices is not really wouldn't be very surprising. Home prices have gone up significantly faster than wages for a number of years now. Mm-hmm. So seeing a correction in home prices wouldn't be, out of the ordinary. I don't think it'd be a big surprise for a lot of people. Are we going to see a home price crash? Well, that goes a little bit deeper. What is a crash? A crash is more than 20% drop. What would cause a bigger than 20% drop? Well, now you have to have more sellers come in. And in order for that to happen, you want to see a real uptick in foreclosures. What would cause an uptick in foreclosures? Well, for foreclosures to really go up, that means that you own a home that you can no longer afford. If that happened today, let's just assume that you can no longer afford your monthly payment. Well, it really doesn't matter. You can just sell your home and you should be able to sell it for a profit. Now, there are neighborhoods around the country where that's not the case, but in most of the country, home prices are at record highs. So if you cannot afford your payment anymore, you lost your job, something happens, you cannot afford your payment, you can just sell it for a profit. So you're not going to see that influx in foreclosures unless that changes. What's going to cause that to change? You need to see people with less equity in their homes. Because now if you're underwater and you can't afford your home, now it's a very different situation because now you're going to be forced to sell or the bank is going to force to liquidate the home for you. And when banks liquidate your home, then they're going to sell it for below market price. So what could cause this equity, the amount of equity that people have, go down? Well, the first thing is you buy a home with less equity. Banks say, we don't want to keep discouraging people from home ownership. We know that home prices have gone up so much. It's harder for people to afford a home, so let's be the good guys. let's let you buy a home with very little or no equity. If we start to see that happen, then that would be another big red flag, because now people are buying homes with no skin in the game. If you have no skin in the game, there's really no incentive for you to continue making your payments or try to afford the home. Second thing would be you see home prices drop. You see a correction. So you had a lot of people buy homes, and most people are buying homes with 20% equity or less. So if we see home prices drop by, let's say 20%, now you're going to see a big chunk in the country that are now owning homes with little to no equity. Well, then what? If you can continue making your payments, no problem. So if you have a fixed rate mortgage, really no big deal, as long as you continue having an income. If your income goes away, your income slows down, now it's a problem. But the bigger problem would be, what about the people that are going out and they're getting adjustable rate mortgages? An adjustable rate mortgage means that you buy a home with a mortgage rate that changes based off of what other interest rates are. So you would get a low teaser rate for maybe 5 years. The first 5 years of your mortgage, you pay a below market value interest rate. That way you get a lower monthly payment. And then at 5 years, you are going to readjust that, and then your monthly payments would readjust. Well, if you got an ARM in 2020, 2021, 2022, your first 5 years of payments are going to be very low. And then after 5 years, well, they're probably going to go up, because it looks like all signs are saying the interest rates are going to go up. Now, we could see something change that if the economy slows down, the Fed tries to go negative interest rates. But if interest rates go up and now people have adjustable rate mortgages, now your home suddenly becomes much more expensive to own, because now you go from owing $800 a month to $1,400 a month. And if you don't have the extra $600 a month, well, now you're in trouble. Maybe you can refinance if you have equity in the property. But if you don't have equity, now you're in big trouble. And we're seeing a growth in adjustable rate mortgages. I did an interview recently. The same day I got an email from Ally Bank. Ally gave me an email saying, hey, get your mortgage from us. We offer some of the best ARMs, adjustable rate mortgage offerings. Mm-hmm. And I was so surprised when I saw that, because you're starting to see more and more banks offer adjustable rate mortgages. Why are they doing that? Well, people are seeing home prices go up so much that they cannot afford these homes at a low 3% fixed rate mortgage. So how do you afford a home if you can't afford the monthly payment at a fixed rate 3% sum mortgage? Well, say that for the first 5 years, you could pay 2% and you get a lower monthly payment for the first 5 years. So we're starting to see more and more people go towards that route where they're taking these ARMs because they can't afford the 30-year fixed rate. So now they're taking the adjustable rate. Now that's extremely risky, especially in this environment where we have some of the lowest mortgage rates in the history of time. Come on, people. If you have the ability to lock in a 3% sum mortgage rate, do that. Why would you go? If you cannot afford that mortgage rate, you cannot afford the home. So now we're seeing more and more people start to take these ARMs. How many? I don't know. I don't know the exact numbers of how many, but we are seeing more. I have a lot of friends who are bankers, and I ask them this exact question. I like to play dumb. It's the best way to get more information out of people. And I ask them, hey, how's the housing market? Are people still buying homes like crazy? And, sometimes they'll say, yeah, they are. Or they'll say, mortgage applications slowed down for a little bit. Or then they'll say, yeah, we're starting to see a big pickup in adjustable rate mortgages. And the first time I heard that, I was like, wait, what are you talking about? He's like, yeah, our bank has been really pushing these ARMs, and people are liking them because they can get the first 5 years at a very low teaser rate. I'm like, what are you talking about? They're like, yeah, we're letting them lock in at 1.99 for the first 5 years. So you're starting to see more people go to ARMs, which creates, again, what does this all have to do with? It has to do with equity. So you put down some money, you take this adjustable rate mortgage. Now, after 5 years, their adjustable rate readjusts. If home prices are correcting, right? There's a lot of different things we're talking about. Now, if home prices are correcting, they go down by 15, 20, 25%, let's just assume. And now the ARM kicks in, and now mortgage payments go up by a decent amount, and you cannot afford these higher monthly payments, then what? Well, now you're going to say, okay, banker, you said that I can refinance. Now you go to the refinancing table, and then they say, you don't have enough equity in the property, or you don't have any equity in the property. Then what? Well, now this is going to increase the supply because then the bank is going to take the property away from you. So this is like the whole range of possibilities. It's a lot of different things that can happen, but it all comes down to understanding buyers and sellers. What causes more buyers? What causes more sellers? Do I think that we could see a correction in home prices? Absolutely. I think home prices have gone up very fast. And so, it wouldn't be a surprise to see correction. If we don't, it is what it is. But, I think it's not a surprise if we see a correction in 2022 or 2023.
Do you see any major similarities or maybe differences between what's going on in the housing market right now and what was going on during the 2008 crash?
Yeah, there's a lot of differences. You had a lot of differences. 2008, you had the ninja loans, no income, no job, no asset loans. You had a lot of adjustable rate mortgages. You had a lot of subprime mortgages, banks lending to people with very low very low credit scores, subprime credit scores. So we don't have that same risk within the real estate market itself. We have stricter lending practices. You have to show an income. You have to put some money down. If we start to see these go away, then I'd be much more worried. But we don't have those same issues. The bigger issue now is really on the economic level. What's going on with our economy and the dollar? I think there's much bigger issues with the dollar being devalued now than before the 2008 crash. What happens if the dollar is devalued more? Well, if the dollar gets devalued, the value of the dollar goes down, the buying power of the dollar goes down, which means asset prices like real estate, stocks, crypto, gold become more expensive. It becomes harder for you to buy these assets with a dollar. So it's almost like a reverse crash if you see a dollar crash. Because if the dollar crashes, the value of the dollar goes down, buying power of the dollar goes down, which makes it harder for you to go out and buy real estate with dollars because, hey, your dollars can't stretch as far. So I think that's a bigger concern than the same 2008 type crash. I don't think we have the same factors as 2008. I think we could see property prices go down. We already talked about what could cause a crash, but we don't have the same factors as 2008. So now if you're talking about investing in real estate, what does this mean? Well, if you want to invest in real estate, you have to be smart. You have to pay attention to the trends and don't just wait for a crash, but instead look for opportunities. Look for opportunities in your area, look for opportunities outside of your area, and look for value add opportunities. Look for areas where there's not a lot of attention yet, but there's people moving too, right? If you don't have a lot of money, you have to be a little bit more creative. And so the way that you balance this lack of capital is increase of creativity. Look for opportunities in neighborhoods where there's not a lot of interest yet. You don't have the big dollars there. So property values are a whole lot less. And so now you can come in and see much higher potential returns because you're coming into an area where nobody's looking. And now you can revitalize a neighborhood. You can revitalize properties where there is demand, there's growing demand, but people just aren't looking there. So look for where businesses are going to. Where do you see that kind of your small mom and pop shops starting to open up? Where do you see coffee shops and cafes starting to pop up? Because if they're starting to pop up, they're the first movers. Your cafes and coffee shops are your first movers into different neighborhoods. And so you start looking at that. And then you start seeing, okay, why would people want to move here? Well, there's some really nice geographic parts to this neighborhood. There's a river, there's a highway nearby, there's whatever. And then you start looking at, okay, are there other businesses coming? Because then once the bigger businesses start coming, that's when you really start to see property values go up. So you start looking at, okay, there's an Orange Theory opening up. Hey, that's kind of cool. They're your mid-range type of companies. You see these small gyms popping up. You see, there's a Chipotle opening up. Okay, so there's more money coming in. And then you start to see the bigger retailers start coming in. So your bigger retailers, your Walmarts, your Krogers, these are companies that are spending a lot more time. Your Whole Foods, Trader Joe's, these are companies that are spending a lot of time researching trends. They're trying to see populations growing. They're trying to see neighborhoods growing. And so if you see that come in, well, it's like, did Trader Joe's or Whole Foods or Walmart just announce that they want to come into this area? What does that mean? Well, that's a lot of jobs. And that's a lot of money. And so if one of these big companies opens up a store, well, then there's probably going to be, your other stores in the parking lot. You might have another restaurant in the parking lot. You might have another retail strip open on the other side. Well, if these companies bring in hundreds of jobs into this little area that isn't getting a lot of demand, they're going to need a place to live. And these property values are going to go up. So you can start looking at, these questions of how do you find value? How do you find this more opportunity? Sure, there's a chance that you could be wrong, but if you want to get in real estate and you want to see more of that potential upside, you have to look at these, these trends, and that's what you want to be paying attention to as a creative real estate investor.
All I know is a new Chipotle means extra guac.
Extra guac. And with that, is it time?
It's time.
It's time for the Guac round. This is where I answer your questions. Now, I'm not a financial advisor. I'm just a random guy on YouTube. And if you want me, a random guy on YouTube, to answer your questions with my opinions, because I'm not a financial advisor, then you can ask me your questions using our link in the description below. All you got to do is call in, leave me a voicemail with your name, where you're from, and ask me your own personal questions, and I will try to answer them with my own opinions on our channel on this Guac Talk show during the Guac round. Now, again, investing has risks. You're never guaranteed to make money when you invest, so always do your own due diligence. And Nate, what's the first question?
First caller today is Adam.
Hello, my name's Adam. I'm from New Philadelphia, Ohio.
Hey Adam, how you doing?
My question is, with the emergence of the crypto market, or not emergence, but with the way it's been growing, I know you've talked about it being like digital gold, but it seems to be much more than that now. It seems to be like a new technology to be invested in. How much do you think is a reasonable amount of crypto should be in a person's portfolio? Should it be like 5%, 10%, 20%?
Good question. So that question is a very complex question. So we talk about crypto, like Bitcoin, being potential digital gold. I did a interview with Michael Saylor, the CEO and founder of MicroStrategy, who owns, I think, $7 billion worth of Bitcoin now. He spent $3 billion buying Bitcoin. And for him, he has moved all of his, pretty much, or the vast majority of their cash portfolio into Bitcoin, because for them, it is that digital gold. It's that protection. For them, it's a property. Now, how much of your allocation goes into Bitcoin is going to depend on how much you believe in Bitcoin. Because if you believe Bitcoin, crypto is the future, well, then you would want to move a bigger chunk of that. Now, you have to understand that it has risks. You could be wrong. And if you're wrong, you want to make sure that you're protected. So the way that you can answer that question is really, how safe are you and how much risk can you tolerate right now? Do you have a stable income? Is your house paid for? Do you have a lot of other debt? Do you have a lot of expenses? If you have a lot of student loans, if you have a mortgage, if you are living paycheck to paycheck, well, this might not be the best time for you to move a big chunk of your portfolio into cryptocurrency, because if that goes down and you lose your job, well, now you're really struggling. But if you are in a position in your life where you can take on more potential risk, then it's a very different question. Because if you believe that Bitcoin is going to be a property of the future and people around the world are going to want to own Bitcoin, well, then you can move a much larger portion of your portfolio into Bitcoin. And then, outside of Bitcoin, you have your other cryptocurrencies where these get a little bit more speculative, and the blockchains can be changing. You have Ethereum, which has a very powerful blockchain, and then you have the Ethereum killers, which, again, different layers of speculation, different layers of risk, different layers of potential upside. Is there potential upside? Absolutely. Is there risk? Yeah. And so you never want to put in more than you're willing to lose. But again, your risk tolerance is going to change on which stage you are in life. If you're at a stage in life where you cannot afford to take risks, then definitely do not put in more than you're willing to lose. If you're at a stage where you're willing to take on more risks, your house is paid for, you don't have all this extra debt, you don't have all these extra expenses, you have an income that's stable that you can rely on, then hey, you can move a much bigger chunk of your portfolio into cryptocurrencies, the ones that you believe in. Just make sure, again, now you're doing your due diligence, because some cryptocurrencies are going to have way more risk than others. Your crap coins are going to have more risk than your Bitcoin. So again, it just depends on where you are in that cycle.
This next question is from Hannah.
Hi, my name is Hannah, and I'm from Virginia.
Hi, Hannah. How you doing? Thanks for calling in.
Would you be willing to talk about the general process for getting an online business started?
Sure.
Like, for example, how do you make sure you're licensed properly?
Sure. Well, welcome to the online business world. When you say getting your licensed property, the best way to do that is to speak to an attorney in your area. Call up an attorney in your area, or you can use a company like UpCounsel. I'm an investor in the company UpCounsel, where you can go and find legal work online, find an attorney to help you through their platform. But the licensing is going to depend on what you're selling. If you're selling an actual product, then you're going to need a sales license. If you're selling something else where you need different licenses, it's just going to depend on what you're doing on the internet. Now, in terms of getting up and started on the internet, the best advice that I can give you is don't spend money until you need to. Do not blow your money. You have this whole group of people, industry, who believe that in order to start a business, you have to do all these fancy things. You need to have a fancy office. You got to have the fancy furniture. You got to have the fancy furnishings. You got to go out and invest in all these things that you don't actually need to make any money. So the first thing you got to do is you got to figure out how you're going to make money. What is your product? How are you going to sell it? Only spend money on those things. If it does not help you drive sales, don't spend money on it. If it's not going to help you increase your revenue, do not spend money on it. So focus on that, and it really comes down to, is it actually going to help you drive revenue? The simplest example I can give you is with YouTube. If you're starting a YouTube channel, a lot of people assume that I need a fancy camera, I need fancy lights, I need a fancy audio equipment, because you will justify it by saying these things are going to create a better production value, which makes my videos better, which makes it a better chance for people to watch my videos, which is a big fat lie. When I started YouTube, made all of our videos right off of my cell phone, my iPhone. There was no fancy mic, no fancy camera, no fancy editing equipment. I bought a $25 light off of Amazon, and that was it. So you really got to dig deep, figure out what it takes to grow the business. I just start generating some sales, and as you start generating sales, then you reinvest back into the company. We have a great office now. We have great cameras now. We have great equipment now, but it came through that reinvestment. So focus on growing the core business first, drive the revenue, then start reinvesting back into the company.
Next up is a question from Katie.
My name is Katie, and I'm from Austin, Texas.
Hi, Katie. Thanks for calling in.
And I want to know if I should help my niece pay down her car before she refinances it.
Sure. So your niece has a car. You want to help her pay it down, and you're trying to figure out if you should do it before or after she refinances it. Well, the question is, what is this pay down going to look like? Because are there first any prepayment penalties? And what happens after she refinances it? If your interest rates are lower after you refinance, well, you're going to be able to pay it down a little bit easier, because now the interest rate that you're paying on that first payment is going to be less. Now, if every additional dollar that you pay is not going to interest, because assuming that there's no prepayment penalties, assuming that now every additional dollar that you pay is going directly to the principal, well, now it really won't matter too much. You can just pay that off now, because assuming that it's a $500 monthly payment, a big chunk of that is going to interest. Well, you have to make the payment, and then you can just send in the extra cash and have every additional dollar go to the principal value, not the interest. Now, if you wait to refinance, I don't know how long this is going to take, but if it takes a while for that to happen, you have to pay refinance fees. You have to pay, wait for that. You got to make all your payments until the refinance happens, and then when the refinance happens, you could be able to send in that check. So you got to play out the scenarios. And I know you might be wondering about the credit score. How is that going to affect your credit score? Well, the big thing with credit score is being able to pay down your debt, being able to pay it off consistently. If you are behind, if you're not making a minimum payment, that's going to have a big dent on your credit score. So you want to pay that down if you are behind ASAP.
This question is from Steven.
Hi, Jaspreet. Thank you for all the great content on the channel.
Thank you.
My name is Steven, and I am from Kankakee, Illinois.
Thank you for calling in, Steven.
And my financial question is, when investing in real estate, and I need a down payment, I am planning to leverage my house.
Okay.
Should I do that from getting a variable HELOC, a fixed HELOC, or should I put a mortgage on the property? Thank you.
Good question. So very fitting for today's video. So you're trying to buy a rental property and you want to use your home. I'm assuming that you have a lot of equity in your home. You want to use your home as the collateral to now use the debt that you can get out of your home to go out and buy a rental property. So your first question was using an adjustable rate or a fixed rate HELOC. I talked about adjustable rates and fixed rates in this video. You do not want to get an adjustable rate. Adjustable rates when you are in a low interest rate environment are so risky, because if you are at historical lows with interest rates, which direction are interest rates going to go? Probably up. So you don't want to get a a variable interest rate HELOC. Now, between a fixed rate HELOC and a refinance, it really just depends on how much cash you're going to need. If you need the more cash, a refinance would be kind of a more straightforward way to go. You pull out money, you lock it in for 25, 30 years, and now you can use this cash to go out and buy a home. That's probably going to be your safest and best bet, but just again, understand the risks, because now you're pulling money out of your personal property. So if you take this cash, you go out and buy a rental property, something goes wrong with the rental property and you lose your income, well, now your home is at risk, because now you have pulled that equity out of your own personal home. So just understand the risk that you're taking. Yeah, the potential upside, but you just got to understand that risk. And with that concludes another Guac round. Thank you, Nate. If you want to see more of Nate, check out the Minority Mindset News channel. He posts videos every single day on the top finance and business news. Amazing videos. So if you have not checked out the Minority Mindset News channel, you need to go and do that. This is Guaci. I'm Jasprit Singh, and this was another Guac Talk.
So you think that Bitcoin, Ethereum, these have the opportunity or ability to 100x in the near future?
The entire space, not just one coin. Everything you touch, basically. Now, there's going to be winners and losers. So that's the financial incentive of why this matters. But it matters at a much deeper level.